So it always amazes me how quickly the weekend flies by. I hope it feels the same for everybody else here. But I'm delighted to now have the final session, which is always, for me, one of the highlights of the weekend. In the past years, we've always had people who invest in funds coming up for this final panel discussion. We've had many family offices, endowments, and individual investors come up here. This year, we're mixing things up a bit. We've got 3 fund managers who very recently started funds, so they can speak much more to the kind of the challenges of getting started and all that kind of stuff. But I want to start with a big thank you on Txomin. The idea for this panel was Txomin's. He pointed out to me, wouldn't it be good to hear about, be able to ask the managers these type of questions. So Txomin, thank you very much for that.
My pleasure, Rob.
So I'm gonna start off asking you guys just a few quick questions just to kind of set the scene. But the focus of this session is really for you guys, the emerging managers, to ask the questions which are top of mind for you. But before we start, I wanted to say a quick thank you. I've had 2 microphone assistants over this weekend, as you all know. So a big round of applause for them. There's Olivia. Tommy. And Tommy has brought a friend along for the final session to provide him with some support, and we've got Valentin here. Okay, so Txomin, as this was your idea, I'm going to start with you. Would you mind just kick us off? I'm sure a lot of the people in the audience here won't know you, who you are, what your background is, and the fund that you've started.
Okay. So my name is Txomin Zaratiegui. I am from Spain. I launched Arras Capital Fund 4 years and a half ago. My fund is domiciled in the Netherlands. And before launching my fund, I worked 8 years for Gala Capital, which is a Spanish private equity company.
Okay, and a few broad strokes about the fund.
Yes.
And the way you invest, where you invest.
I invest in Europe, Canada, the US. I focus on quality companies that can dominate a niche that I can understand, that I think that is attractive, and that they can serve with good returns on capital and a pricing power that I can assess. So, and ideally with low capital intensity.
Okay, perfect. Pratyush, would you like to go next?
Hi, everyone. My name is Pratyush Rastogi. I'm based out of Singapore. I run Fair Wealth Advisors. We're an asset manager that manages money for high net worth individuals and family offices. We have a few solutions, but our main one is our flagship fund, where we invest in concentrated equity all around the world. We have about 15 positions. Generally, we look at companies that are growing market share in markets that are growing. I'm also the genius who walked up the hill with all his luggage instead of taking the lift up. So take everything I say with a pinch of salt today.
Yeah, that's a good hint next year to point out there is actually an elevator that goes up the hotel here. I forgot to say one thing right at the beginning. Why these 3 gentlemen? All 3 of you are relatively new to me. The reason I chose you is because from our interaction so far, I've enjoyed them enormously. You've recently started, so I think your experience is much more relevant to the group than an old folk like me. I almost can't remember. It was so far back when I got started. And thirdly, each of you are from a different sort of region of the world. So we have Txomin, which I've kind of got you as the sort of the European fund manager. So people with questions more around sort of European structures and European regulation and all that kind of stuff. Txomin is the ideal person for that. And then Pratyush, based in Singapore, so can speak to Asia. Obviously, I'm less familiar with that, but I'm sure you know that much better. And Rom, who is based in the US and can speak to the kind of the North American market. Okay, so Rom, would you like to introduce yourself?
Yeah, well, first of all, thank you for everyone for taking the time and listening to what we have to say, and Rob for organizing this great event. I found the past events to be very educational resources. So this is a great public service for emerging managers like us. In terms of a little bit about myself, my name is Rom Wilson. I run a small fund called ACM Capital, based out of Boston. We primarily do global developed equities. My background's in M&A, and so I was the idiotic associate who was raising his hand to work on European and Japanese transactions concurrently, so I've always enjoyed sort of having a little bit more of a global perspective, and also had a bit of time working in an infrastructure in China. So that's the way we've invested. Concentrated, probably like many of the folks in here and peers on the stage and Rob. And other than that, you know, I think the other thing is, you know, a little bit of a restructuring background as well, so tend to look at companies a little bit more holistically, both on the equity and the debt side, before investing. So that's a little bit about us.
Yeah, so happy to invest across the whole capital structure then, yeah.
You know, we actually did that a lot more in the beginning. We found some great debt with equity-like returns, whether it was, you know, for example, like AMD or Micron debt, you know, maybe 5 or 6 years ago. But I found as we've scaled and we're starting to attract more institutional clients like endowments and foundations, they don't really want the complexity of that. So we don't do that as much anymore. We're probably purely concentrated equity at this point.
Got it, okay. So the question which will be top of mind for everybody, so I'll ask it straight off of the bat, is, you know, how do you get started? You know, every aspiring fund manager has this chicken and egg dilemma that without a track record you can't attract capital, but without capital you can't start building a track record. So maybe starting with you, Txomin, how did you solve that chicken and egg dilemma?
Okay, so in my case, I found my seed investor. I think that this is like the golden question that every emerging manager wants to ask, right? So how do you find the first capital that is going to invest is going to seed your fund? So in my case,
maybe just a tiny bit slower with the Spanish
okay.
accent. It's maybe a little bit
so
difficult.
In my case, I found I knew a family from the Middle East. I was very good friends with the son. Before they invested in my fund, I knew them from 8 years before. We had almost 1 decade to speak about life, investments, their business, my own business, my work in private equity before, and especially in the years before launching my fund, public equities, right? When I started, I will tell you later about this, but I think that it's very important that you guys start investing early and showing building some kind of track record that you can explain to others. I cannot understate how important this is. So by the time that I told them I am thinking about quitting my job in private equity and launching my own funds to invest in public equities, I didn't need to ask them. They said, well, we will seed you. And that was the very first source of capital that I had.
Yeah, and I think that's how Buffett and many of us started, is having someone, you know, someone to support you and who's willing to believe in you. Right?
Yeah.
Yeah.
So an idea for the audience: if you want to launch a fund, and you are, and that's probably one of the reasons why some of you are here, that was the reason why I came here the first time. Probably you already know the investors that are going to seed you. So think about it.
Thank you. And Pratyush?
Yeah, I think the how. Before the how, it's really important to think about why you want to start a fund, and that leads to the how. And this might be slightly controversial to say, but you got to really think about why you want to start a fund. And there's 10,000 plus funds across the world. Does the world need 10,000 first fund? And it's usually, there's many good answers for starting a fund, but it's usually you're either trying to solve a particular problem for a group of investors or a client base, or there's a particular niche of investing that you have that you look at. And in my case, that was really important because my clients who originally started with me came to me because they were having a problem. In Singapore, most wealthy individuals and family offices are banked by private banks. And that causes a lot of issues because the way private banks are incentivized and structured, and I won't go into all the details there, but obviously they weren't very happy with the service they were getting. So they came to me, and these are people I knew, to say, can you help us build something better and help us invest our capital? So that was the why, is really solving that problem for my client base. And then that led to the how, and the how, we actually started originally just as advisory. And advisory is actually a pretty decent place to start to build confidence with your investor base, to build your own reputation, to build your own success. And it's kind of low it's not a very big hurdle, right? Because people don't have to invest money with you; they just listen to you, and then they can decide on their own. So that was a great way to start. We started with that for the first year and a half, and then we launched the actual fund in July 2021. And all those customers who I was advising came on to the fund.
Fantastic, yeah. And then Rom, with you.
Great. No, thank you. So my hows and whys are a little bit different, but I would agree with the framework. I mean, mine is a little bit unconventional, which is basically, I followed my wife to Boston. She had placed at Boston Children's and Harvard for postdoc studies. Tough thing to say no to your partner for, so it was my turn to move for her. And I was excited about it because I think her second choice was in North Carolina, which would also be a great place to live, but much smaller financial services industry. So I was excited about Boston. But I think one thing that even long-running Bostonians will tell you, it's a very networked city. It's a very insider city. And when I moved there, I knew one person, a classmate from college. So actually, the way that we got started is, I was approaching the job search there and encountering a little bit of resistance despite a great academic background and a great track record of just sort of breaking into that. There's a very good friend of mine, a classmate from Stanford, who was my freshman dorm mate, and I've gotten to know him and his mom and dad and his sister, the entire family. And we were just sort of catching up about life experience, and he called me back a few weeks later and said, hey, my dad always thought that you'd make a great entrepreneur. They've been serial entrepreneurs in the healthcare business, and we're in the process of setting up a family office. And he said, if we gave you a few million to start, would you give it a shot? And I think part of the decision, in addition to knowing me, is that it's a Chinese-American family, and they'd had their own struggles in the 70s and 80s of breaking into the healthcare industry and getting something started. So I guess my how was really this very, modest, a huge offer for them and for me, but modest in the grand scheme of asset management. But, really thinking about it for a month or so with my wife, and I'm like, well, maybe opportunity knocking doesn't look like $500 million on day one. Maybe this is what it looks like. And then we kind of went through the thought exercise of, I do love investing. I do think at some point I did want to start something of my own. And we sort of did this exercise one night where we thought about every 5 years. And it's like, okay, well, will it be better to do this 5 years from now? And it's like, well, 5 years from now, maybe you're on to families, or you have children who have their own balance sheets. Basically, the best time to start it was either now, and at the time I was 35, or when I was 65, and I'm not sure if I'll be around and have the energy when I was 65. So that was really the genesis of it. And since then, I think like these gentlemen up here, we found some great high net worth individuals, family offices, and endowments and foundations who've come on board and helped us scale.
That's fantastic. One last question for me, and then I'll hand it over to the audience. There's the chicken and egg structure problem, which you have to resolve as a manager to begin with, but there's also the whole kind of morass of legal and regulation. Without going too deep into the weeds, can you just describe perhaps the legal structure you went for and perhaps what the considerations were behind that decision?
Okay, I'm try to be brief, but I am European.
I know, it's a huge question, but just
so
if we just set the framework, what the legal structure is, and then people can dive in if they want to.
There are three drivers for your structure. In my case, I was limited to Europe. I wanted to self-limit myself for European structures, because even if my seed investor came from the Middle East, they are sophisticated and they had investments in Europe before. I expected that in the future, most of my investors will come from Europe. So in Europe, there are two key frameworks for fund management. One of them is the UCITS format that is similar to the mutual funds that are very diversified. And then the other framework is the AFMD or hedge fund framework. And whatever that is not a UCIT is a hedge fund in Europe. And there you can fit funds like Rob and mine, private equity funds, real estate funds, and even funds that invest in art. So within the hedge fund, I wanted, I mentioned before the three factors, but I didn't tell them the three they are. One of them is the investment strategy that you have, how much you want to diversify. That is a big determinant. The other one is the origin of your investors. That also determines the jurisdiction where you want to launch. And then the third one is And the third one is the size of your investment. So if you are agnostic regarding diversification, if you have more than 20 million, and if your investors are coming from all over the world, you have many good options to launch a fund. If you start like me with only 1.1 million euros in AUM, and you want to be concentrated, I mean, really the amount of choices that you have is like 3 in Europe. So in my case, I thought, okay, given that I want to concentrate, that my investors are going to come mostly from Europe, and that my running costs should be very low because I only have 1.1 million in AUM, basically the 3 jurisdictions that I could choose from were Malta, the Netherlands, and also some special vehicles in Luxembourg. And then I chose the Netherlands because I just found a partner that I thought back then, well, these guys seem legit. They seem to be consistent. They are sophisticated enough to onboard investors from all over the world. So that's why I chose them.
Perfect. Thank you. Pratyush?
So we run through an SMA structure, and the obvious thing that people think about when SMA structure, why they start like that, is because the costs are low, and Jacob in the last talk talked about this. But there's 2 important things to why I think I'm a big fan of starting with SMAs when you're just getting started. And there's
just so it's clear what an
SMA,
SMA
separately
is.
managed accounts. So the account is in your client's name. They can see all their assets. You're just basically executing on their accounts. Thanks. So there's 2 buckets of trust that I think it builds. One is with your client. They can log in and see their own money. They can see all the trades you've made, and it basically makes sure you're not the next Madoff. And it builds a lot of trust initially. It also builds trust, in my case, with the regulator. The regulator is a lot easier, and sorry, I don't want to say easier, but it's easier to get approved when you're not custodizing your own assets. When you're not the one actually touching the money. And if it's in the client's accounts and it's with already an established broker or custodian, then they're a little. It's a little easier to kind of get the regulatory aspect approved. So it's trust with both your clients and the trust with the regulator. And so I think SMAs have worked out really well for us. And I'm quite a big fan of it starting, when you initially start. There's obviously issues when you scale and things like that, but good place to start.
I think the SMA route is a great route to go down if you kind of want to keep costs low,
Yes.
have low regulation, and also maybe when you haven't quite established your reputation yet, it probably gives the client a little bit of extra comfort that the assets remain in their name. So it seems to me a great route to go down.
Yeah,
Rom, what about you?
Yeah, great. So I also think the SMA is a great structure to start. I did not start with it for different reasons. I think once I got the opportunity, as I explained to you guys, I've always taken research very seriously. I was the idiot who read through the entire college handbook of every course, while choosing professors or whatnot. So one thing I did, because it takes a few months to get set up, is I literally just interviewed every single investment manager / founder who will sit down with me, and that ranged from guys who'd started funds that were 2 to 5 million, all the way to some luminaries who gave me some, an hour, 30 minutes of their time to talk about their early experiences 2 or 3 decades before. And I think one thing I decided early on is I wanted to be ahead of whatever stage of development we needed to be for the next step. There was one person in particular who was the CFO of an $8 billion fund, and he recommended strongly going the onshore fund route, so we don't have a master feeder structure. Just going the onshore fund route, because he basically said, at the point that you're looking to get endowment and foundation investors, many of them are going to want that structure, and you don't want to be taking months to build that in order to get the investment in. So we did that very early, as well as, we didn't really talk about service providers. But one thing I would encourage emerging managers to do is, you're now a business owner, so, put your negotiating hat on and see what deals you can make. So we were able to get, we didn't get the gold-plated ones, but we were happy to start with the bronze-plated ones and develop our process. And I think one of the pitches I made to our service providers is that, look, this is our AUM base. This is what it can support. I didn't want the additional stress of, leveraging my entire personal life. But the promise that I made them is that at these different asset thresholds, we will step you up immediately. And we'll, let's say, for example, with some of our service providers, we'll find a way to do catch-ups either by getting additional services from you or whatnot. So we were able to start with a pretty full suite of, good legal advisor, good accountants, good third-party admin, and really have, more of a scalable structure from the beginning.
Yeah. Service providers is obviously also a big topic area, but I'll leave that to the audience if that's a path they want to take the conversation down. So I'm going to take 2 of the microphones away here, and then you can just pass the microphones amongst yourself and pass them to my assistants. There we go. And yeah, if you have a question, I'm sure 2 young men will be very excited to give you the microphone. One up the front here.
Hi, thanks for your time. Question on how you manage the trade-off between marketing and doing research, especially when you're subscale early on in your life?
Just, Txomin, do you want to go first? I'm sure
So in my case, de minimis, that means low-cost funds like mine, they are extremely restricted in how much marketing you can do. Okay, so basically, a fund like mine can only, that's one of the trade-offs that I had to accept. But my fund can only be sold under reverse solicitation. That means that I cannot cold call anyone, or I can go on social media explaining my returns. The challenge that I need to solve is that people need to hear about my fund from ear to mouth, go to my website, register, and once I have an email with a timestamp that this person on that day requested information, then I can open my letters and send my fund's information. So I could post openly ideas or investment ideas, or I could speak about my portfolio management strategy, but there's a thin red line that I cannot cross. So in brief, my marketing is very restricted. I cannot proactively market the fund, but I have created some letters that I hope that they are of the interest of investors. And once you have this, and you have a track record in which the investors can infer from the letters how you are going to behave, that is the kind of marketing that I can do now.
And I think that could be a blessing in disguise, as it allows the right investors to find you rather than you going, trying to find a needle in the haystack out there.
Yeah, I agree with that. I think that there are some factors in how you build your structure that help your investors self-selecting to reach you. Well, another one is the kind of fee structure that you have, because with that you can point a little bit on your intentions.
Perfect.
Potential question for the audience.
Thank you for asking that question. I think it's a really important question because it also highlights that you have to remember you're also running a business. It's, you can say it's just a fund, but it is a business. And so marketing is an important aspect of it. So I think the way I think about it, and your question was how do you deal with the trade-off between research and marketing? Because it does take time. So the way I think about it is my marketing is an extension of my research. So I'll give you an example. So I write a blog on a monthly basis, and most of it is about anything I've been interested in over the month. Either it's a company, or thinking about markets, or thinking about a particular way of investing. And I'm already thinking about it, and it's already part of my process, and it's something that's helping me in my business and investing. So I might as well just write it up and see if anybody else finds it interesting. So that leads to a lot of conversations, or some conversations, and then people come to you. And then, like I think everybody's mentioned, Rob does this wonderfully, is the letters. You have to write those letters anyway because your clients are going to read them. And if you can, regulatory permitting, put those publicly, then people can read them and find you as well. So it is a task that you have to do, but you can also make it so that it's not a completely separate task. It's really just an extension of your research and your own work. I hope that made sense.
What's the name of the blog? I'm sure everyone would love to sign up.
It's Fair Wealth. It's just the blog on our site. But it's our bi-weekly blasts, and I need to change it because I only do it monthly now. But you can go to our website, and it's the Substack link is there. Yeah.
Okay, Tillman, maybe you can try and add that to the notes if you can. That would be fantastic, so people can see it.
Awesome. So I guess generally about marketing, to share a little bit about our journey. I mean, in the first year, I was very purist about it, and it was a good thing actually. I think some of those luminaries that I mentioned were just don't spend any of your time marketing, and so first year or two, I was like, okay, just very disciplined about not spending more than like 10% of my time like doing any marketing, and that was good, right? Because there's a lot of hay to bale per se. There's a lot of wood to chop in terms of getting your process right and getting your operations right and everything like that, right? I think that a mentor, an investor, and one of our supporters, I remember having a meeting with him, and it's one of those things that it's not so profound when you lace the words out, but it was profound in the moment. And he basically said, Rom, anyone who's going to invest with you at this point already knows you, and or is in a position to take a risk, right? And that really sort of crystallized some of the successes we were having. And he actually introduced us to a few institutions. And lo and behold, one of our first institutional investments came from a founder who was exactly in that position. They'd founded a $12 billion allocator, and they didn't look around and worry about whether they would lose their job or anything like that. They put us through a rigorous due diligence process and invested. So I think the takeaways are: be mindful about how much time you spend marketing. Be mindful about whether you're actually spending time with people who can allocate at your stage of development. And then I guess maybe just one thing to say on the regulatory side, since it was brought up. I think that's particularly important from the beginning. Like we're registered with our state regulator because we're not large enough to be registered with the SEC as yet. But I think as part of that, they put us through a very rigorous process where they're looking back on everything that we did. So even from day one, you have to be careful about making sure, at least within the North American regime or the U.S. regime, that you're speaking to credited investors, like you're documenting this well. Your third-party admin is documenting that very well. So that becomes very important.
Awesome, thank you. There's a question there at the back, Michael.
Hi, thanks for taking my question. So you've been explaining how you have your first investor, how you market, how you set up regulation, and how you all do this. But can you also talk about the management versus performance fee, and how you think about deciding for one or the other or both, and in what mixture? Thank you.
Okay, so I think that like all of us here, I was very inspired by Warren Buffett. I really like the fee structure that he has in his first partnership of 25 over a 6% hurdle compounding. So when I launched my fund, that was the structure that I already had, right?
So you copied the Berkshire
I copied this one.
Yep.
I must say that I thought that this is what was the most fair, and I still think in the long term it is. But in my case, I think that I underestimated how difficult this is when you have some rough years.
Yeah.
So when after my fund was 3 years old, the returns in the first 6 months were not great, but the 2 years after they were much better. And when I thought about, okay, now I'm going to enter stage 2 of the fund, I am going to increase the capital base of the fund to admit more investors other than my seed investors. How is this going to evolve? And then when I thought, okay, instead of having my A class of shares, I am going to launch now a B class of shares, and the remuneration it is going to be 25 over 6, but I could charge up to 1%, not necessarily 1%, up to 1% of management fee, but I take this management fee as an upfront payment of the performance fee. So that means that if I have 2 years in which, let's make an imaginary case, but I have 2 years in which I am making no performance fee, I need to have some money to finance my own expenses, then I'm going to charge, let's say, not 1%, but 30 basic points, because that's what I need for break even. But whatever that I charge to that investor, that is going to be taken out of the future performance fee. So in the long term, it is pure performance fee. That is one class of fee, and then I have two other fees that help investors self-selecting themselves. So one of my obsessions was to have stable capital. So I said, okay, I'm going to have 2 more fees that are not going to be for my profit. They are going to be for the profit of all the investors in the fund. And one of them is, okay, if you invest today and you want to redeem tomorrow, you have to pay 3%. And this 3% goes down by 8 basic points for every month. So in 3 years, this disappears. And the other one, it's okay, it's up to 1% if you want to redeem outside of 2 liquidity windows every year. So that helps me, you know, whenever I explain that to an investor and the investor says, well, I want to have monthly liquidity and I want to rebalance every year, this investor is automatically self-selecting himself out of the fund.
That's a great idea. Yeah, awesome. Pratyush, do you want to go next?
Yeah, I don't know if I have a great answer of how exactly you should figure out the fees. For me, it was very much a conversation with my client base and what was fair on both ends. So we have a management fee, which is about 1%, and it was just enough for me to kind of cover expenses and make sure I could feed my family. And then we have a performance fee, and this is where different people have different ideas. Our performance fee is over what we earn over the benchmark. So it's what and the benchmark is the all-world index. And for me, my thinking of why I thought that was fair is because if my clients aren't going to invest with me, their simple alternative is just to buy the ETF. Right? And if I'm not at least giving them better returns than that, then why do they really need me, right? So I need to. So I feel like once I've given you at least that threshold, then I can take a performance fee. And my clients felt that was fair as well. But it's a good question, and I don't know if I have any sort of recipe or thing. And I think it's really important that you do think about it, and your LP base or your investor base is also on board with that and also thinks it's fair.
Yeah, I think that's a great point. I don't think there's a cookie cutter approach, one size fits all. It has to work for the manager, and it also, of course, has to work for the clients. Yeah. Rom.
Yeah, so I think like many folks in the room, you know, I too am a great fan of Buffett and Munger, and I think when I was approached with this opportunity and thinking of structuring it, I was thinking about structuring it in the vein of the Buffett partnership as well. You know, starting with like a 1% fee, and I would always joke. I think actually, maybe I'm wrong, and someone here can correct me if I am. I think they actually started with like the zero, like management, and it was all performance on the Buffett partnership or whatnot. And I would always joke with folks, but Warren was also, I believe his dad was a senator or what. My dad is not a senator, But anyway, so when we launched with like a 1% management fee, and it was purely mathematical, right? It was like, we're launching with a few million, here's what it translates into. And I made the commitment to the family of, I think I basically put about 80% of my net worth into ACM, either investing alongside them or basically sponsoring the operating costs in excess of the management fee, for at least 3 years. That was the commitment that I made. So we started out with that fee structure, but honestly, I would love over time to get to zero and whatever, maybe at a point of independent wealth. And so I think the commitment we also made is that we would step down the management fee as we scaled, and we stepped it down once very early on to 85 once we got our first large institutional investment. And I think that that's something that we'll continue to do as we hit these different scales that allow us to do that. In terms of structuring the performance fee, I sat down with one of these industry luminaries who's highly well regarded in the allocation, and they're like, well, the Buffett partnership seems great, but it's a bit anachronistic. I think everyone wants kind of a transparent, like, relative hurdle that they can judge you by. So, and we took that to the family and asked them what they wanted, and so in the beginning we launched with management fee and hurdle versus the MSCI world as a relative hurdle. But different investors have different preferences, and actually there are many of our investments who prefer the fixed hurdle. So long story short, we have both. It doesn't affect my investment style at all. Like, I don't try to maximize the fixed hurdle. I don't try to maximize MSCI hurdle. Basically we're looking for the best 15 to 20 days we can find. And I just make sure the clients are educated, because everyone thinks that they're getting like some super great deal, but I just want you to know that if you're doing the fixed hurdle, there have been years where we've massively outperformed, and you'll pay performance then. If you're doing relative hurdle, there'll be years where the market's down and we're down less and you're paying. So just client education around that is very important. But I find that client preferences for that are highly diverse. And we try to give them a choice in terms of how they pay for performance. And we try to give them a commitment in terms of like, look, we too want the management fee to go down as we scale.
No, I think, Rom, why don't you keep the microphone so you're not always going last and you get a chance for the next question to go first. But I was just going to say, no, I think it's a great point that the fee structure has to work for the manager as well. And if you're not independently wealthy, then you have to have a game plan, because markets can go against you for very long periods of time. And if you've got 0% management fee, you need to have a game plan for that. Yeah.
Oh, absolutely. And I think the other thing I do, I think, feeding ourselves and our families eminently important. And I throw that out as number one, but maybe a close second. I just talk to people about the resources of this business, right? Like you need a budget to go and visit companies or their competitors to actually kick the tires. You need a budget to afford better services. Like a big thing of the last few years. And this is an interesting segue. It should be a big thing for all emerging managers to think about your cyber plan, right? Because there are certain things that can really maybe kill you reputationally before you even get out the gate, right? And so
cyber attack or
like cybersecurity, right? So like these things, there aren't free cybersecurity firms who are just out there advising and hardening for nothing, right? So all of these require a decent budget to afford that client protection and to afford the research that can enable the prospective outperformance.
Got it. Thank you. Who wants to go next? Oh, we got a question from the internet.
Question
Nick.
from the internet. We're going to challenge everybody. Do you have one book you might recommend that helps you think about becoming a fund manager? And if not that, perhaps just one book that you'd recommend regardless. And maybe not a Buffett book, given how much Buffett we've done today. Or it could be a Buffett book.
No, the challenge of the book recommend. I'm going to recommend one of the classics. Sorry guys, because it might take away one of your recommends, but it's
This was a good one to have the microphone first on.
Yeah, no, this is one benefit. I guess for me it'd probably be the Graham and Dodd, and like Investing Bible, and the reason I would recommend that is because I reread it every 10 years or so. I mean, you don't have to do that, but the reason I do reread it every 10 years ago is like the first time I read it, I think I was 24 or 25 in business school. I maybe understood 50% of it, and then when I was 34 or 35, I was like, this could be interesting to revisit, and I understood a lot more. And there's a lot of hidden gems. The structures of the market may not be the same, the security types may not be the same, the risks or the crisis may not be the same. But I think a lot of the learnings around how to approach situations, value them, and the psychology of managing through them are important. I guess without outing her too much and revealing her identity, my wife is also a psychologist, right? So we have a lot of conversations about that. I think the psychology of the business is, and I don't have a recommendation on the book there. I don't think that there's a good book written about there are good books that talk about the psychology of investment management, but sometimes I read some of her books to just understand psychological biases. And I think that that's an important part of being an investment manager. I think particularly kind of knowing what your own biases are. I think through the environment of last year, I spent quite a bit of time speaking with our analysts about basically how sometimes when you're winning, you're losing, and sometimes when you're losing, you're winning. And just that general sentiment of kind of the risk appetites you have when everything is going your way, and a little bit of maybe I'm a genius at this investing thing creeps in when you're having a good run, and just sort of managing that. So I would recommend, in addition to all the tomes and Bibles about investing, maybe people pick up a book or two about just psychology in general and managing the mind.
Awesome, thank you.
So I don't know if I have a book on reading about becoming a fund manager per se, but I think it is an entrepreneurial journey you're going on. So I think there's a lot of great entrepreneurial books. And the one that always comes to mind is Shoe Dog by Phil Knight, which is a great book. If you haven't read it, I highly recommend it. It's basically the founding of Nike. And not that I'm saying I'm trying to build the next Nike or anything like that, but there's a lot in that book that really describes the entrepreneurial journey well. The highs, the lows, the near-death experiences. And you can really relate to kind of the good things that happen, the high stresses that happen. Give you an example. For a lot of fund managers, 2022 was a very, very hard year. A lot of people were down, and it's a triple whammy, right? It's your client's AUM's coming off. That means your revenue's coming off if you have a percentage management fee, plus your personal net worth because you're invested alongside your clients is also hurting. And so, there are hard months in there, and books like that really just, you read them and you realize, everybody goes through them. Everybody goes through these really, really difficult times, and you just kind of have to work past it. So I think any book, really good books on entrepreneurial journeys are highly recommended. And that one, if you haven't read it, I would very much recommend it.
I am going to follow your style of recommendation. It's not a book about investment, it's a book about entrepreneurship. And the book is called The Startup of You. And if I remember well, it was written by Reid Hoffman, who was the founder of LinkedIn. What was definitory for me launching my own fund was a process that lasted about 2 years, in which, besides having, of course, my day job in private equity, I started thinking increasingly seriously on launching my own fund. So what I did in these 2 years is to interview with as many emerging managers as I could. One of them is sitting in this room, is Mr. Matthias Richert, who was here sitting before also. So I was in touch with Matthias. I sat down with Matthias to understand a little bit of why he did it, how he did it, etc. So to answer the kind of questions that you guys are answering today. So this book, The Startup of You, is a book that helps you thinking about yourself. Who are yourself? What are your resources? What are your strengths? How can you balance your weaknesses? And how do you leverage yourself to become an asset manager?
Awesome. If I can throw in as well a recommendation specifically on how to structure a fund, it would probably be Portfolio Management by David Swenson, where he really talks about the kind of the pitfalls and all that kind of stuff. Any more from the internet, or should we go back to the room? Okay, there's a microphone there, Jonas.
3 questions. Number 1, how many years did you track your performance before starting your own fund? Second, what gives you the confidence of delivering value compared to 10,000 other fund managers? And number 3, how much of your own money did you put into your own funds?
So the first question is, how long did you, was your track record, right?
How many years before you start your own fund did you track your own record?
Okay, second.
What makes you confident that you're good?
Time? Okay. Yeah. No, I was just trying to see if I can answer them all at once. Be really efficient, but I can't. So the track record question. So mine was about 5 years. So as I said, I started with advisory first, and before that, I was actually working for a family office itself. So I had a record from there. So that's how I tracked. And by the time we launched the fund, it was about 5 years.
Should we just keep
it
short? Because there's 3 questions and 3 speakers, otherwise it might get a bit longer.
So first question. In my case, I made a mistake, and the mistake was that given that when I started seriously investing in public equities, I was between living in 2 different places that were Dubai and Madrid. I had different accounts with different banks, and my investments were were divided between accounts.
But just broadly, how many years were you investing?
So I realized that was a mistake. What I strongly recommend to everyone wanting to build a track record is that you develop at least 2 years of track record, as I did in an account in Interactive Brokers. Interactive Brokers is going to give you really great tools to show your track record and your relative performance, etc. It's very sophisticated for what you can do with a regular account. So I did that for 2 years, and that was enough for me to convince some investors to invest in my fund.
Got it. Thank you, Rom.
Yeah, so just really quickly, so I was doing investment banking before. I was investing my own PA there. Then I joined the buy side. I had about 5 years of a track record that I couldn't port, right, because there are rules around that from previous employers. But I could speak to and talk to investors. And then maybe just one quick book recommendation. That's what I was looking up.
Yeah, sure.
Leadership in Turbulent Times. My father-in-law gave me that. Doris Kearns Goodwin. The reason I recommend that is because, you're as an emerging manager, your trip is not going to be up to the right. You're going to have difficult years like last year. And I think unfortunately, there's a lot of mythos in the great people who've had turbulent times. But there's some useful advice there of how to process those and find your footing and decide what you're going to do next.
Awesome. Keep the microphone. You can go first this time. The second question, Jonas?
What makes you confident that you can deliver value?
That's a good question. I don't know. I'm going to answer it with a parable. So if you guys follow the Berkshire stuff, I think Charlie Munger has this funny story about someone coming to him about asking him how to be a composer of sonatas or something. Do you guys know what I'm talking about? Yeah. All right. And Mozart says you shouldn't do it. You're too old.
You're too young.
You're too young. And I think the person's like in their late teens or something, and they say, well, you were 8 or 9 when you were composing. And Mozart says, yeah, well, but I wasn't going around asking people to... It's a very Charlie Munger story to tell, and everyone can take away different things from it. I think the thing that I took away from it is if that person really wanted to compose sonatas, it's great to ask Mozart, but he wouldn't have cared what Mozart said, right? If you feel a calling to do it, obviously the track record helps if you've had some early success and you know that you can do it well. But I think the most difficult part of being an emerging manager is managing yourself, managing through an incredibly challenging journey to actually scale, right? And to fight the literally, 5 or 6 years into it, probably thousands of no's that you will receive. So track record can help, but you really have to know that you want to do this, and honestly, anyone else's answer to that question won't matter to you because you'll feel like you have to do it, like it's part of your journey.
I am 100% confident. No. 1,000.
That's what we like to hear.
No, but you obviously have to be confident, right? You can't go into it and be like, I'm not going to do very well, otherwise, what's the point? But there's no guarantee that anything will happen. And I think the only things you can do is work your butt off, earn every day you come into the office, earn that confidence that those investors have put in you, and do your best on that day, and be self-reflective when you mess up, figure out why you messed up, and learn from that, and be open to all sorts of new knowledge, and be open to all sorts of interesting investment ideas, and learn from everybody. We can learn from everybody, and then kind of put in that effort, and the outcome hopefully will happen.
I think that you develop. This is a path that is not done for you. This is a path that you have to walk yourself, and the price that you pay for walking this path is that you have one certainty, and it's not that you are going to make very good returns. The one certainty you have is that you are going to make mistakes, and that you can. I think that the way how I see other managers handling their mistakes and myself is one of the best proxies for the future success of these managers. So when you see someone that is honest about mistakes, transparent about mistakes, that can self-reflect and that can learn from this, I think that this is the way to assess that not only that yourself, that you are learning from it and that you deserve to be on this road, but also to even select other managers and the kind of friends that you want to share your ideas with.
Pratyush, why don't you get the next one first? And the third question was... Oh, did I miss you out?
No. What was the third question? Sorry.
How much of your net worth is in your fund?
So not including the home that we live in, the liquid net worth, 90%. And the other 10%, I actually personally invest in other managers, some of them who are in this room. And so, yeah, but 90%.
Yeah, just really quickly, I think maybe one other thing I'd add to the last one is the confidence is that you can learn from mistakes and make better decisions, right? Like I think accompanying that confidence is also a healthy dose of humility because you will mess up. I think in terms of the question, I think for me it was closer to 80%, and the reason for that is at the time, like my wife was like a graduate student doing incredibly noble work for very low pay. So, like the 20% was reserved, so literally we would have, living expenses for 3 years. And so that's the way that I approached it.
Yeah, it's very good. It's important to think about that.
My answer is very short. It's about 90%. I rent a house. I wish I could buy one. That could happen in the future.
Super. Probably time for a couple more questions. Okay, one here.
Hi. How do you handle client communication, and how much of an educational part is in your job? We had many discussions this week around fund managers that, for example, cannot invest in China, And let's say you find this great company in China and you go to your client and he says, just no, try again.
It's a really great question, and I think you got to be very careful about the type of clients you bring on. And if you bring on a client, that has certain issues or causing problems, that's really your issue for not vetting them well, and it's not their fault. It's just not the right product for them. I have two types of clients. I have clients who have the time to invest, but not the ability, because they're really good entrepreneurs, but don't do investing. And then I have clients who have the ability to invest, but don't have the time. Like they're working for hedge funds, or they're the traders, or doing their own things. And so those are the type of two that work well for me. And yeah, obviously on the former you have to do a little more education. On the latter it's a little easier, but the latter also asks harder questions sometimes, than the former. But both types are great. I'm very thankful for both types of them. And yes, sorry, to answer your question, client education, communication is constant. You're constantly writing to them. You're constantly trying to explain why you're investing in the things, and you should have really good answers for the things you do because they deserve it.
I completely agree with your points. I will just add that one thing that I have discovered is that client selection is extremely important, not because of you want to have this kind of patient, stable capital that is absolutely necessary for you on every moment, but especially in moments like 2022 when everything goes down. I only had one little redemption, and he was one investor that after investing in the fund, I just discovered that perhaps this product wasn't adequate for me. And it's, as you said, it's not his fault, it's my fault. So I think that I see the onboarding process of clients, and this, in some cases, years that you spend with them, is something that is going to compound for you in the future. If you do it right, you are going to minimize your future headaches. If you don't do it well enough, that is going to create some potential future headache. That being said, I only have 9 clients, so that is very easy for me. If I had 900 clients, like some large funds have, this might be a different story. So please assume with my answer that this might work in my case because of my particular structure and number of clients.
Thank you.
Yeah, I mean, I think current and prospective client education is always important, and so this is a great question. One of the first questions I ask people, when they're considering becoming prospective clients or I meet with them, is I just say, like, how do you want to be followed up with? And it's not because I lack the confidence to control that schedule myself, is that some people want to be followed up with 2 or 3 times a year. Some people want to hear from us every quarter, and you don't win any friends and get investors by becoming a nuisance or annoyance to them. So I think that very naturally leads into when they do become clients, asking them again, like, how do you want to manage this? How do you want to be followed up with? I think in a very general way, so we write quarterly letters. I'm a little bit jealous because ours are fairly detailed as well, of the biannual, but we write quarterly letters, and I think it's a good exercise to basically congeal our thinking and present it to current and prospective clients. We also have sort of an open door or an open Zoom or open phone policy for any of our clients. If they want to call us, we'll talk about any positions in the book they'd like to talk about and whatever depth they'd like to talk about it. And then the other thing is, having gone through, 2020 and 2022, where you have these market dislocates, and more importantly about the market dislocates, we wrote this funny letter called The Feed, which is basically just the way technology works. So, like, it'll just constantly be feeding, like, a set of headlines that, kind of convinces everyone the world is falling apart. But so when we see that happening, we do get more proactive in terms of reaching out and just saying, hey, you may not need it, right? Like, and you didn't reach out to us, but like, do you want to talk about what's happening in the markets? And we'll tell you how we're thinking about it, and give you some calm about what's happening in the book.
Awesome. Probably time for one last question. Sorry about that, but I think someone's got a microphone at the back there.
Hi, my question would be in terms of software. What types of software do you use to support your investment process, to structure your portfolio, or to also do research? And I don't mean Excel or Teams, but more maybe more sophisticated. I don't know. Do you use Notion or Capital IQ Excel plugin or whatever, right?
Given that there's not super amount of time left, and I think that could go into a lot of, maybe just like some of the best software you use, maybe 1 or 2 sentences on why you use it, and then if someone wants to dive deeper, they can continue the conversation afterwards. Yeah.
Yeah, no, I mean, I think there's software that we use throughout the different functions in the business, but I think your question is more directed towards like research, and I think like the previous speaker, I think was it Jacob or? Yeah, like the previous speaker, like I've always had a fairly like fundamental get into the K's and Q's, and we do that for the ecosystem around the companies we invest in. So we've always been oriented in that way. Software-wise, you know, we use sort of the typical things that you would expect, like FactSet and CapIQ. But I think there's a lot of, if we're talking about psychology, there's a lot of research about deeper learning occurring when we read from the page, right? So and there's some sophisticated things you can do within even those software in terms of setting up like, you know, quantitative screens that are driven by standard deviations or more complex formulas. But I think that that's really kind of the primary tool, and you know, we use some of the tools provided by our prime brokers and you know, our different OMSs and EMSs.
Almost nothing. I'm very cheap. Honestly, like we have a few things, but if I really need something, I have a good network of other friends who are investors, and if I need something from Bloomberg or CapIQ or something like that, I can usually get it from them. Yeah, I spend very little on software.
Yeah, I have a very similar case to you. I am, as an emerging manager, I wish that I had discovered before that the software that for me has created the most value before launching my fund and after launching my fund is actually the software that is built into Interactive Brokers. So Interactive Brokers has some built-in tools to explain your performance, your ratios, your geographic distribution, sector distribution, etc., that are better than super expensive solutions from 15, 20 years ago. So that's something that I really wish, and if you guys are thinking about launching my fund, let's have a coffee later and I will tell you on how much value this has created for me, because this simplified things and made my life easier.
Thank you. I guess appropriately you had the last word, as it was your idea to do the panel today in this format. So thank you again for that. I know there are a few hands still up. I think all 3 of the speakers are still around for at least a few more hours. So feel free to approach them and ask them any questions you have. And difficult to believe, but it's already 12 o'clock. The time has passed. And all that remains for me now is just to close the conference. And it's been an enormous pleasure to host everyone once again. I think in my letter, I described the way I think of my life, probably most people think of their lives as a movie. And in a movie, you have lots of different characters and potential interactions between them, and that, of course, leads to plot lines and outcomes. And when I was very sick in the summer, one of the plot lines that interested me the most to see how that was going to continue is this meeting. So I'm really very delighted to be able to be here today to host it. I hope it continues for many, many more years, and I hope to see many of you again in the future. So thank you very much.